Proud supporters of Africa this week. Engine, with us, you are number one.
A research study on sustainable investment in Sub-Saharan Africa was launched in South Africa this week. The report aims to determine the current state and trajectory of development of sustainable investment in Africa. Graham Sinclair, sustainable investment strategist at Sustainable Investment Consultants, who researched the report, explained the findings.
We've got a range of opinions, and that's some of the approach that we took on this project. We spent 23 months interviewing people both on the continent and outside the continent, because you need to pick up the story from both ends. And also from the point of view that the largest institutional investment market in Africa is actually South Africa. There's a lot of money heading north of the Limpopo, for example. So we find in the main, and we have some of our key findings, references the first thing that investors are looking for. They're looking for risk-adjusted return. They're looking for correlated returns. They want returns from Africa that are going to be different to some other geographies and or themes that they're choosing to invest in. Next to that, though, and fundamental to the research report that we were able to conduct, is they're looking for good corporate governance. And it's very basic when you think about it, but so very important. Net for an investor, you want to see your money come back to you. That's what corporate governance is about.
I mean, obviously the perception is when we talk about corporate governance, we're talking about all sorts of measures to alleviate corruption, but apparently the definition is broader than that. Now we're looking at environmental standards, we're looking at social impact. How important are those kinds of facets?
Absolutely, and so the key phrase perhaps for your listeners to walk away from and from this report is ESG, environment, social governance. ESG is pretty much a catchphrase that we use to describe sustainable investment. And very much these are interrelated. So you can have a well-run company, but if it's not thinking through what it's doing with its pollution, or perhaps reducing the footprint of water that it's using, how many liters does it take to make 1 liter of wine or beer, then they're not managing all their resources to the best of their ability. They're not being most efficient with shareholder capital, but also with natural capital that's available to them.
Let's talk about those shareholders, because effectively they can institute checks and balances. I mean, if we're looking at South Africa, for instance, some of the pension funds, PIC for instance, and others have signed up to the so-called UN Principles of Responsible Investment, and effectively are saying to the companies in which they invest, we want to see your track record. Are shareholders vigilant in that way?
It's kind of tough to say. I mean, we've seen a large growth since 2006, April. New York Stock Exchange is where they launched around 30 different pension funds, asset owners who signed on. And the GPF, the Government Employees Pension Fund, was an original signatory and is a board member of the PRI. Just this morning, we had the chairman of the PRI here in Johannesburg to help launch the Code for Responsible Investment in South Africa, which is a further development and a reaction to corporate governance, to King 3, now looking to investors to take it up a notch in terms of following some basic principles. There's 5 principles. For me, the most important really is the 5th principle. It's about transparency. It's about investors explaining to the people whose money they manage. These are professional investors that are managing other people's money, trying to explain the approach they take and being much more transparent with their decisions.
Now, for a listed entity, it's probably easy, I'm making an assumption here, it's probably easier to monitor their performance because you get financial reports, you are allowed to investigate a little bit more. A lot of money is coming through the private equity space where it's really difficult to find out how far the tentacles of that company go. Private equity listed entities, how do they fare?
So that was one of the fundamental reasons why the IFC commissioned this report that Cinco did together with Rescura. Rescura have a private equity business and asset consulting. And that's perhaps why we had to do some deep digging and took a while to do. There was a counterintuitive finding though, Loretta. The counterintuitive finding was that there's relatively more use of ESG factors by private equity funds than listed equity funds or general asset management. And first of all, we weren't quite sure why, but as we kept asking the investors that we spoke to, the private equity funds, it became fairly apparent. If you're a private equity investor, you going in, you can't come out tomorrow afternoon. You're going in for 5 to 10 years, particularly in Africa where the model of private equity is about active ownership. You're trying to take a small growing business and grow that larger. You are the growth capital being made available to that company. So a positive opportunity that we find for private equity is that private equity funds are integrating ESG factors. We found 1 in 2 funds in the last 3 years have managed money for development financing institutions who have a mission to make sure that their capital, their assets are being deployed in frontier markets, but that they're being deployed in a way that doesn't impact negatively on the environment and people and so on.
Some people who are a bit more skeptical will say, yeah, governance is very important, but we're also here to make money. And if we're going to be looking for companies that are environmentally astute, socially aware, we want to ensure that we can also get a return on that investment. And consequently, we're starting to see SRI funds or talk of SRI funds being set up. What's the impetus for that?
Well, our finding kind of illustrates some of the tension. So if you think in terms of what's on the label and what's inside, that's where we found, for example, less than 1% of assets under management in this 3-country study were so-called ESG labeled. It was on the label in the same way that you would have a hybrid car or you'd have a biodynamic wine, for example, versus where ESG is integrated at some point in the process. We found that's where we found $125 billion US in 2010 was invested in some way using ESG factors. Now, in fairness, and I'm an analyst, of course, it's self-reported numbers, and we'll take that further in future years and drill down deeper, roll up our sleeves. But definitely there is a substantial asset base today in Africa looking for investments, and when they're looking for investments, they want to know that company is a well-run company.
Capital markets and deepening capital markets is a major challenge in Africa. As you said, it's easier to monitor JSE-listed companies because the JSE is a global bourse, one of the top 20, etc., etc. What happens when we're talking about other capital markets in Africa? Because a lot of the work is being done in Nigeria, in Kenya and South Africa. The hotspots, the traditional emerging market destinations for investors. What happens to those on the beaten track, off the beaten track?
And those are, very much beyond frontier markets. Those are high-risk markets to be investing in. And, I'm not sure if the graphic is available, but one of the graphics that I found very interesting coming from the study is a graphic where we tracked the MSCI Emerging Markets Index over the last decade, pretty much a benchmark into emerging markets. It doesn't include some of those frontier countries, but there you can see over time relatively even how South Africa's portion of that index has reduced as Brazil and China have got bigger and bigger. The other huge takeaway that looks like a big bite out of a chocolate bar is the effect of the global financial crisis in 2008 and 2009. I've just come back from Kenya a couple of weeks ago. There's a great appetite to move forward and to integrate into capital markets internationally, to be appealing to international investors. The awareness about corporate governance is very, very high.
The World Bank this week published its South Africa Economic Update. The report's co-author, Sandeep Mahajan, lead economist for poverty reduction and economic management at the World Bank, explains South Africa's challenges.
We are looking at the trends in the South African economy, but we are also looking at the longer-term structural challenges that the country is facing. For example, in the first issue, we look at the challenge of raising the savings and investment performance in South Africa.
I mean, let's talk about that, because obviously local savings does prompt local investment and just creates a more dynamic pension fund environment. And it's the one thing that's been lamented by Trevor Manuel as Finance Minister, by Pravin Gordhan. They talk about it, but we're just not responsive. Why is that?
Well, one thing we find being a challenge on the savings performance is the unemployment rate. When people are unemployed, when they don't have jobs, when the dependency ratios are high, then the savings tend to be low. So we feel that, and at the household level, that seems to be a constraint in terms of savings.
Some would say, if you looked at the Gini coefficient in South Africa and the huge inequalities that exist, that's also one of the problems that we're facing. It's not just that people are unemployed, but it's the fact that those who are employed have to carry so many other people within their social network who are not employed. And so it makes it really difficult to advance a savings case. If with my salary I have to send my brother to school, my cousin to school, take care of my grandmother, and so on and so forth. That seems to be a real problem in the country.
Absolutely, and inequality, unemployment, these are two sides of the same coin. But we also point out in the report that actually this is a time of opportunity in terms of savings. South Africa, in fact, has been seeing favorable demographic transition in the last 15, 20 years, where the young dependency ratio, those who are under the age of 15 relying on working age population, has been shrinking very fast. That in other countries has translated into different outcomes, more savings, more growth. We haven't seen that happen yet because of high unemployment.
Right. We also have the problem of sluggish growth. I mean, growth for 2011 at best will come in at 3.2%. The government insists, you know, to really create jobs meaningfully, this economy has to be pushing 6 to 7%, but that seems really far off.
That seems far off. There will be a big push that will need to come to raise it to 6 to 7% because we haven't seen it yet. And one of the key areas where attention will have to be given, of course, is to lift the investment and saving rates that we see so far. What we have seen in other countries across the world, which have been able to maintain the momentum on 6 to 7% growth for a long period of time, has been that their savings and investment rates have been in excess of 25%, which is quite a way off from where we are in South Africa. But again, the message is optimistic from our side, also on the investment side, because what our report shows is that the investors are facing fairly competitive rates of return in South Africa.
Yeah, and of course, I mean, savings will also be prompted by the interest rate cycle, which is meant to turn at least by the end of this year and next year. Do you think policymakers have the right kind of approach?
I think so, but as I said, I mean, you know, there are no easy solutions here. If unemployment or youth unemployment is one of the key constraints to savings, then it's easier said than done. Then a policy framework has to be much more holistic. And again, jump-starting economic growth will be very important.
What about proposals that have been made, and they're just proposals where, for instance, there must be a compulsory levy or tax that's going into some sort of a national savings scheme? I mean, a lot of proposals have been mooted from the previous administration. Sure. Would that work? Lessons we can learn from other countries, maybe?
I'm not particularly aware of the proposal that you are referring to, but what we have seen is that any tax incentive schemes or any tax schemes that the government puts in to raise the savings tend not to work very well. Okay. What does work is government savings coming from the expenditure side, and there we know that there's a very robust program by National Treasury over the next 2 or 3 years to do that, and that is going to produce some higher savings.
Foreign direct investment, that's also seen as a huge catalyst to drawing in investment and economic activity in the country, but we're told that post-credit crisis the FDI rate has dropped somewhere between 60 to 70%.
I think that may be because we saw a spike a couple of years ago, but overall the longer term trends in FDI in South Africa have not been very high. And that is a little bit surprising because, as I mentioned, the returns on offer in South Africa to investors, and these are not portfolio or equity investors, these are long-term investors, have been pretty high. They've been increasing over time, they are high, and they're globally competitive. And we should see a much more enthusiastic response from investors.
On the fiscal side, I mean, you said that we would see savings if we were to look at it from the government expenditure side. We know that government's going to be spending a lot. A major infrastructure build program. They're trying to incentivize business to create more jobs, especially in labor-intensive industries like manufacturing. So you're going to see a more active government. Is that necessarily a bad thing when we consider the debt to GDP ratio in the country? Should the government you know, just be bleeding money like that?
Well, the expenditures actually you mentioned are all growth promoting. So that's not bleeding money, that is good expenditure. And the government has a program that it's put in place for the medium term where it will start rolling back some of these expenditures. So to the extent they promote growth and we see the program play out, I think it's a good thing. And South Africa's debt to GDP ratio, in fact, by global standards, is very low. So I wouldn't be very concerned about that.
What can we do as citizens? And I'm not asking you to prescribe, but obviously the government's also saying, business, come to the party. You need to be creating the jobs. We're just the enablers. We need to be promoting SME developments. Banks, you know, loosen up those taps. Let's see credit flowing.
Sure. Well, you know, again, I'll go back to the environment that the investors face here. Investors look at two things. They look at returns and they look at risk. South Africa is a fantastic place to do business. That's what our results are showing. There is a lot of money to be made here. Returns are high. So, of course, the focus has to shift on the risk side to make it more predictable for investors to come in and invest in South Africa and create jobs.